I'd like to call the meeting of the North Pension Board and seek approval of the minutes from the September 11th meeting.
Okay, I have a problem with the minutes. I raised this a couple of times before, but the rules say they have to identify who made a motion and seconded, whether it doesn't count. So we've got the approval of the minutes, there was a motion to approve. There was a second, but identify who made it. More importantly, for the approval of the pensions, there was a motion to approve the pension application, and that's not valid. I don't remember who made the motion to approve the minutes. I made the motion to approve the pension application.
I think I might have seconded.
Yeah.
You seconded, right?
Yeah,
And we do the same on the minutes.
I'm sorry.
Same on the
Same
minutes.
minutes.
Step on the minutes, that's fine.
Right.
Yeah.
Okay. All right.
So those changes should be made. Any other changes? Vote to accept the minutes as adjusted,
I'll move to approve the minutes
as amended.
amended.
I'll second
And
that.
then second,
All in favor?
and hopefully they'll put those in if you, Charlie. All in favor?
Aye.
Aye. Opposed?
Aye.
Is there any public comment? There's no public comment, there's no pension application, so principal dynamics.
Sure, yeah, great. So I know Marnie's on virtually and we have Chris Corbett and Mark Shapiro. So principal, formerly Columbus Circle, has been a long time pensions mid-cap growth manager. They went through some team changes about 3 or 4 years ago at this point. So we had him in, I think about a year ago, and want to get an update on strategy and performance. Here, why don't you come over here?
Come here.
Yeah, can we squeeze two in there, Dave? Is that all right?
Here, I can sit on this side.
Sure, we can put another, you want to swing another chair in here?
Yeah,
Is that possible?
Sorry.
Yeah.
Excellent. We ready to jump in?
We are ready.
Okay. Well, I'm sorry I couldn't be there in person, but really nice to meet you all. Thank you so much. It's always a pleasure to meet in a longstanding client relationship. So thrilled to be here with City of Norwalk and your Callan consultants, Britt and Kevin. So nice to see you all. My name is Marnie Hart. I joined Principal in January. I had our consultant relations business actually, and am based out in the Western region, so in California. So I'm sorry I can't be there, as I said. I would love to at some point have the opportunity to meet you all, and want to thank you for the business and for the longstanding relationship that we have. I know that you know the two gentlemen that are sitting in there live with you quite well, Chris and Mark, Chris Corbett and Mark Shapiro, key members of our investment team who have deep experience and focus and dedication in the small and mid-cap space. So Chris was named co-PM actually 7 years ago now, and Mark was elevated in 2020. So the changes I think that Britt was referencing now have actually 4 years behind us is when Cliff decided to retire, and I think continues to very much enjoy his time in retirement. And so I think, you know, the two of them have demonstrated their continued focus, their dedication, working side by side and committed to delivering for clients such as yourself. From an organizational standpoint, you know, Principal continues to be very committed to delivering for our partners, which is to us, our clients such as yourself, managing $553 billion in assets across equities or private and public markets, I should say, on behalf of our clients. And that is what we are committed to doing. That's what we continue to do. About 137 billion of that is in equities across the spectrum. And the firm continues to have a commitment to that. We brought in George Maris, who is our CIO, our Chief Investment Officer of Equities, and really enables teams such as our dynamic growth team that you all are invested with, to have the deep resources, to have access to investors globally, to share insights and benefit from the breadth and the resources and foundation that Principal can offer. Along, very importantly, with our parent company, PGI, that provides that financial stability as well and long-term outlook, so that we are very much aligned with our clients in our long-term goals. So I know that the time here is really spent with my colleagues speaking and not myself. I just, I want to just make sure that you have a good foundation and that I turn it over to them properly. We want to use your time wisely. We're happy to make this conversational. They continue to manage 1.1 billion in assets on behalf of our clients and are here for you. So, I'll turn it over to them, let them dig into the process. But if there's anything you'd like us to do, we know we have 30 minutes of your time today. Happy to focus where most beneficial.
Yeah, maybe refresher on the team's philosophy, and then talk about positioning and performance, if that works for the group.
Yeah, sure. Okay, so before I get into performance, I'll let Mark do a quick refresh on our discipline and how we do things.
Yeah, sure. So thank you very much for having us in today. I think it's been about a year and a half since we've seen you all. So at the highest level, the philosophy is fundamental momentum, positive surprise. Another way to say that is we invest in good companies getting stronger, as well as those fundamentals and companies are exceeding investor expectations. So some investment managers look for one, either improving businesses or companies that are exceeding investor expectations. We look for both. The way we get there is we look to identify some type of change on a company-specific secular industry or macro level that will provide sustainable positive momentum and positive surprise. So to kind of boil it down, if you think about, I'll go to page.
Yeah, that's essential stories. Page nine.
Page 9. So when we look for change, we look for it in 4 categories. The first would be company specific. So that could be a new product or new service that company is launching, where the launch of that product is going better than expectations and will provide the company a sustainable improvement in their fundamentals for a long period of time. It could be a change in the management team of the company, where maybe the company was mismanaged or poorly run beforehand, and you bring in a new CEO or new CFO, and that leads to a sustainable improvement in the margin profile of the business, and maybe they allocate capital better, and it drives longer term and sustainable growth relative to its previous management team. The second bucket of essential story elements that we look for are secular. These are the ones that you probably read in the Wall Street Journal or you see on CNBC, which are, it could be, buzzword today is artificial intelligence. Other ones would be the adoption of electric vehicles, or said a different way, the electrification of industries. It could be, automation, reshoring. Those are kind of the secular essential story elements that we look for. The third bucket of essential story elements are industry, which is, I always think of the easiest one to explain would be a kind of a change in the competitive landscape. So maybe you have an industry that has 4 key players, and maybe the fourth and the smallest one gets taken out by the second largest player. So now you go from 4 to 3, and all of a sudden the pricing, the pricing dynamics for the remaining 3 players improve on a sustainable basis, leading to margin upside. And the fourth kind of bucket of essential story elements that we look for are cyclical. This is our least preferred bucket, just because any change in fiscal stimulus or monetary policy is hard to predict, and it's always changing here and abroad. So that's kind of our least desirable category of essential story elements that we look for in terms of identifying change. So, yeah, so then if I go back to go back to page 8, so, once we've identified, kind of a small handful of what we determine are the key essential story elements for a particular company. The next step in the process is to identify and determine what the expectations are, and that, tying back into the positive momentum, positive surprise element of the discipline. So we look at a variety of sources to determine the investor expectations. So that could be your traditional sell side consensus, Wall Street expectations. It could be what's being discussed in different trade presses. It could be just traditional company guidance, setting an expectation for future revenues and earnings. So once we determine what the expectations are for those essential story elements, then we track how the company is performing relative to those expectations. And we look to own and add to positions where the company is exceeding those expectations, and we will sell or not own companies that are falling short of those determined or expectations. And just kind of the last piece of this is, obviously that creates a portfolio or builds a portfolio where you own companies that are getting stronger, as well as, because we're looking to own a variety of companies with different essential story elements, it creates a nice kind of thematic diversification of a portfolio. So that's, I guess maybe the most important part too is at the bottom, we continuously monitor every position in the portfolio, obviously, and Chris sometimes uses the Olympics analogy, which is the high jumper, which is to say, you have some very growthy companies that are exceeding investor expectations. At some point, the expectations get so high that you can't jump over that high bar anymore. So you can have a great growth company, but if the expectations are catching up to reality, we will choose to exit a position like that or take down the size of the positioning, just because it's not fitting both the fundamental momentum and the positive surprise element of the story. And we can use an example. Recently a cosmetics company, e.l.f., which is a very fast growing cosmetics company, which we had owned for a while, had been a big winner. They were still growing very fast, but the expectations were simply catching up to reality. So we chose to exit that position. And subsequently the stock broke because reversion to the mean is a friend of the value investor and not the growth investor. So I'll leave it there, maybe for questions.
I think it leads us to the very high end of the growth pool for our stocks. So we're dealing with stocks that have very high valuations, very high growth rates inherently. One way to, try to simplistic way of thinking of discipline is maybe the perpetual form of the dividend discount model, where price equals dividend over K minus G. K to cost of capital and G to growth rate. If you replace the dividend with EPS, that leads you to a small change in the growth rate. If the market believes it's durable, can result in much higher PE valuing much higher earnings.
What percentage of your stocks are in the Russell 2500?
Our discipline is to buy the market cap of the company we buy will be within the range of the top and bottom market caps of the Russell 2500. But we have pretty high active share. I'm not sure if I know it off the top of my head right now, but I'd say like 60-70% plus active share. We're not benchmark huggers. We're aware of what's in the benchmark, but we don't try to own every stock that's in the benchmark. It's got to have a good company specific story that enters the portfolio on a bottoms up basis. So
Turnover is how high?
It's run close to 200% more recently. I'd say historically it's more around 150. And I'd say the increased turnover over the last couple of years is a function of, I guess, the amount of fiscal stimulus that's been in the market, the ever-changing expectations around interest rates and inflation, and whether we're going to get a cut. Is inflation running too hot? So it's kind of been a little bit of a trendless market in that regard, and it's caused positions not to run like historically we've seen them run a lot of time. We usually go in with the thought process that our initial position is, like 12 to 18 months is the holding period that we look for. And, it seems that a lot of the best ones kind of start stalling out around 6 to 9 months over the last 2 years is what I would say. That may be changing as we go forward and hopefully will, but that's kind of the nature of what's, occurred.
Does that change your thought process on like your entry level in terms of like where you start, knowing that you're gonna kind of burn through it faster?
Yeah, that's true, that's for sure.
Yeah, well, we try to, we try to be early in identifying a change all the time, so.
Yeah.
And we've been trying to keep the portfolio fresh for that very reason. That said, we do have stocks that have been in there for some time, like a Kava for.
Right.
It's like.
But in terms of how much you hold, like,
Yeah, we definitely have, we traditionally start at a 50 basis point active weight.
Yeah.
Yeah.
And we definitely, I would say, and I don't have the stats here in front of me, but we've moved faster in terms of increasing the positions. And, and again, I don't have the numbers in front of me, but, going from 50 basis points active to 1.5%, 2%, it has been definitely a faster pace, I'd say, than historically.
Right.
Just to your point around with a shorter holding period, you have to take advantage of the opportunity that's given to you.
Right. Right. Okay.
Are you applying technical analysis to determine when to sell this, when to sell it? How do you determine you want to sell it? Given that
So
it's such a short period of time.
Yes, I would, sorry, I would go like, so back to the whole, looking for companies that are demonstrating fundamental momentum and positive surprise. When do we determine to sell it? It's when one of the times is when expectations catch up to reality, and the way we gauge that is every quarter that we rank every stock in the portfolio. It can be anywhere from a 0, +1, +2, +3, until +3 would be a company that, doubled the revenue expectations and the earnings, surprise was greater than that. When the stocks and the story and the surprise goes from a +3 down to a +2, even though they're still exceeding expectations, we'll take a very close look at that and say, is there a fundamental reason why the expectations have caught up to reality, or are beginning to catch up to reality? And that will be one reason why we will look to reduce it. If that makes sense.
It does.
Yeah.
Sorry.
But on a technical basis, if a stock is, shot up
Breaking it.
30%,
Yeah.
40% above the moving averages and gets really extended, we've probably been a little more proactive in taking a little bit out of it, because there's been so much stuff there's been definitely a value undertone to the market in a lot of these periods, especially fourth quarter last year, a little bit in the third quarter of this year. And rather than give that back through reversion to the mean, we'll take some profits. And then if it starts breaking moving averages, we'll ask really tough questions of our analysts. Is there more to what's going on here? We won't sell it just based on, hey, it broke, but it'll be maybe something's going on here that is a little different than we have expected based on the mosaic of information that's available to us. And, we'll dig into it a little deeper even, so.
You used the term surprise a couple of times. Explain that or define it.
Yeah, so if you look at page 8 of the presentation, we're looking for so we determine what the essential story elements of any investment are. So that could be a new product, right? So it could be the sales of that product and the interest in that product. Then we determine what the average investor's expectations are for the sales of that product. And when I say surprise, we're looking for reality, the actual sales results of the company to exceed what the average investor's expectations are for the company.
So, yeah.
So you're not surprised.
What's that?
So you're not surprised.
Right, so and so then I guess the follow-up question would be like, what are we tracking that? Why are we not surprised when others may be? There's a few things. One, we're trafficking in small and mid type of companies where there's less coverage. you mentioned the benchmark before, 2,500 companies, and there's a lot more that we can traffic in just given liquidity and market cap. So, we're just, I would argue our ears are closer to the ground in the names that we hold, and between channel checks, speaking to sell side analysts, looking at what the competitors and suppliers are reporting and talking to in terms of the industries that the companies that we own participate in. On a daily basis, we're monitoring kind of expectations versus reality to make sure that we're trying to, hold companies that are demonstrating positive surprise.
If you look on page 9, all these different sources of change. Are there handful in that, there's several lists there that are kind of dominating your, and getting through your algorithms? Things with products, is it, management change, what,
It's all, there's a lot of them that are a starting point, like a management change where you get a new CEO. Sometimes that can be a reason to look at a company, and then you find out what he's doing. Is he maybe shrinking some of the money losing products down to zero and investing in some more higher growth products. So, we look, that's a good starting point for change. I mean, most of the companies we have, or I'd say a bulk of the portfolio, you're talking about them gaining market share in a secular industry. Those are the two predominant things that we probably like the best. I mean, there's new products are helping them gain share. Generally those sort of products will have pricing power because they're market changing, and there's a high demand for them.
how many companies you're kind of putting through this filtering process?
Well, it's, I mean,
SMID universe?
yeah, it's the whole SMID universe,
Okay.
And inherently there's going to be some slice of that doesn't meet the liquidity requirements to, we generally try to not hold stocks that we can't liquidate in a day or two, I think formally we say 3 days, but it's, we're
So you're digesting data on 2,000 plus companies.
on a continual basis, yeah.
Is this there's an algorithm?
No, we're not, we don't.
scraping Data, or how are you getting all that?
Yeah, I mean,
Information on all
it's a
this.
lot of, it's a mosaic of information. I mean, it's some experience, right? We have myself, Mark, and Elisa are very senior overall. Elisa's done consumer for a long time. I had done tech for a long time. Mark's done healthcare, industrials, and some financials for a long time. So you get used to, we know a lot of companies within the universe already and have a base sort of knowledge, but because we're looking for change, it's like little snippets you read every day. You might, there might be news in earnings season, there's more news, but on a daily basis, there might be news on 5 to 10 companies in an analyst universe. And it's up to them to put that information where they're seeing some change together with the rest of the mosaic, and they're filtering it down to see, well, that actually is worth digging more into. But they do have a baseline knowledge of the companies. It's a little bit qualitative. We've I guess over the last year or two, we've put together a little bit of a, I guess you could call it an algorithm, but it's more technically based in nature, that identifies stocks that are rising on a lot of volume, that are making a move more than its industry counterparts might be doing. So we get a list every morning that's, it's generated, and, there's probably, 5 stocks where it's hit that screen like 4 or 5 days in a row. And it shows stocks that potentially have some company specific news that's driving it higher. And that's like, hey, analysts, go look at those. So that's a source. Mark and I are looking at a lot of different things. We send stocks to analysts. They're looking at them on their own. So it's a lot of that. We don't screen quantitatively on a database, because we're looking at leading indicators that are, if we identify the essential story elements correctly, they're leading indicators. So when a company reports revenue and earnings, the positive surprise isn't necessarily a surprise to us. It might be a surprise to the market, but because we've been tracking, hopefully, the leading indicator, it's not necessarily a surprise to us. We like to say that if it ends up in a quant database, it's already happened, and it's kind of too late for what we do.
Picked up and that got your attention.
Yeah.
Somebody already figured something out, right?
Well, but it's usually very early when you start seeing those things. It's not, it could be the beginning. I mean, generally speaking, we don't mind being well, we don't like to be wrong, but I'd rather be early and be wrong than late than be wrong, because if you're late and wrong, you give back a lot of, potential valuation expansion that
Yeah.
occurred, and you get really killed. Those are the stocks you see down 30-40% when they miss, versus if you buy something where there's just something that's changing right now, it's just, maybe it's done nothing for 5 years and a little change has occurred at the company. Yeah, down 5%, it's pretty good risk reward, especially if you think there's a positive story developing there, so.
Are your analysts sort of in regular communication with CFOs and CEOs before you buy something?
No, we don't put a high premium on management interaction. That's not to say we don't do it.
Mhm.
But we feel like managements of corporations are putting out the positive spin on the data. We'd find it much more interesting if you were to go to, a Wall Street industry conference in New York City, to sit in a breakout session and hear what other investors are asking about, because those are the kind of the points that, people are worried about this or that, or, they want to know what's growing, and just kind of another data point and filter for the process, so.
Okay.
On page 11, we show this thematic diversification.
Yeah.
Is this almost like your organization too, where you're looking at, it's almost like by industry almost. Looking at basically grouping by industry and then being able to kind of ferret out rankings of companies in those industries. Is that how you're really doing this, and then looking at those that are
Well,
most attractive? How does that work when you look at these things?
I guess thematically, it's probably worth talking about, because it's one of the, I think one of the things that helps how we differentiates how we look at risk. Every company on this page enters the portfolio on a bottoms up basis. So every analyst has looked at each name on a bottoms up basis. You're right, with these major, healthcare technology, they're kind of more the broad ones. So they're not really, I guess they're more macro themes, and underneath it, you have a little bit micro themes. So we don't, the theme sort of kind of falls out of what's in the portfolio on the bottoms up basis. So I'm trying to think which one of the artificial intelligence, could probably SciTime is the one in this category that we bought first. So that entered the portfolio on a bottoms up basis.
Yeah.
We ended up having other companies within artificial intelligence like Credo. They make copper interconnects. So their interconnects go essentially on NVIDIA's EPU board or GPU boards. So they're being put in, hyperscale data centers, and there's a big volume play. The hyperscalers they've gone from one big customer to 2 to 3 to 4 that are now ramping to be 10% customers. So that's the micro themes are just stocks that share common sources of positive surprise. We diversify our portfolios. We look at it on a GIC sector basis, like everyone else does, like how much we're weighted in technology versus the benchmark, how much we're weighted in consumer versus the benchmark. But we also look at it because we're identifying the sources of positive surprise, like in this case, artificial intelligence. Like in 2000 at the top of the internet bubble.
Mhm.
In 2009 in the or 2008, 2009, the great financial crisis, then you could own a farm machinery company like Deere. So you own an industrial, you could own a fertilizer company, which is a materials company, Mosaic or Potash. You could own a bank, maybe in the Midwest, you pick the name there. So you have three sectors. You're diversified across the gig sector perspective, but the positive source, the common source of positive surprise was all oil price, because at that time there was the government mandate to burn corn into ethanol. So Deere was benefiting from high farm incomes. They're putting more fertilizer on the field. So you're diversified across these as well, because you could you could have like 30% of your portfolio and think you're in 7 sectors, but you're really only in energy in that case, right? So same in the tech bubble, right? You had the software and the internet, like where the eyeballs were. You had Cisco making the equipment. It's all the same. It was all the same trade back then. Yeah. So we diversify across a minimum of 7 themes, I believe, with no theme more than 25%, although I don't really remember a time when any of them were 25%. It's been a while, so.
On page 12, your real estate holdings is 0. But then on page 18, you have Jones Lang in real estate at 2.5% of the portfolio.
Am I looking at the wrong?
I think I've,
One's 23.
sorry to correct you, but I think we have 3.3% in real estate as of
September.
September.
This is.
Yeah, you're looking at 2023, the first column on page 12.
Oh, yeah, that's last year. So it's kind of, if you look, that's trending and then the benchmark's on the right column. Yeah, so. So that's,
What's been the driving force behind your tech reduction? You know, the end of last year, you're significantly overweight. Now you're underweight.
yeah, it's really been, you know, AI has been such a driver of all these stocks. And, you know, semiconductors particularly were such a strong performer last year and really the beginning of this year. And you started seeing some worries over NVIDIA and the Blackwell cycle that got delayed a little bit. You started, you know, seeing people a little nervous over the hyperscalers going to continuously raise their forecasts. You saw probably a little more of a correction in the analog areas like auto and things like that. So we proactively took a lot of profits within semiconductors. That weight came way down. We were pretty overweight. I'd say we were like maybe 600, 700 basis points overweight semiconductors at the end of last year. And that's kind of come in more towards like 0 to maybe positive 100, 200 basis points. Can't remember exactly off the top of my head. And at the same time, a lot of the plays that we probably made a couple mistakes within software in the sense that we tried to buy some of the consumption-based software names that benefited from artificial intelligence. And there are a lot of fits and starts with that, like where you know, we own Elasticsearch and Confluence, where they maybe worked for a quarter and then like the fundamentals went south again. It just kind of you know, budgets got under greater scrutiny as the economy slowed a little bit in places. So, you know, we sold a couple of those names. So we're underweight software right now. You know, I think there's going to be a market for those at some point, but I'm not sure how close we are to it. But that's been a driver of technology coming down. I'd say other things that have happened over the last year within healthcare, that weight stayed, you know, fairly stable, but within it, we've reduced, what are we reducing?
Like an Alpha Tech, some of the med
Yeah,
tech.
some of the med tech names that hadn't worked out, and we've, with you know, the Fed being more of a cutting cycle, we've tried to take a big underweight in biotech up a little bit more towards equal weight. We're still probably 300 basis points underweight within biotech. You know, we're not huge fans of biotech because even with perfect information, you could come to the end of a trial and, you know, it's in the envelope, please, and the stock's up or down, you know, 20%. But we try to, so we've tried to diversify our holdings in biotech across you know, across a number of names, which has probably resulted in our name count up maybe, you know, 5 to 10 names relative to where it's been over the last 2 years. But that's just kind of, we haven't been in biotech in some time, and we try to look for companies where there's some level of validation and some more than one shot on goal. We're not trying to buy a binary, you know, if this trial fails, the stock goes to 0. If this trial fails, yeah, maybe it'll be down 10, 15%, but there's 3 or 4 other things that, you know, are still prospective catalysts that could drive their business. So
Where just stepping back, where do you think the market on AI is? Are we kind of at the beginning? Is it overinflated now? The real payoffs 5 years down the road? I mean, how would you characterize it?
yeah, I mean, I guess
All the above, maybe.
yeah, probably a little all the above. You know, the expectations on NVIDIA, I mean, not that NVIDIA is a mid-cap stock, got so inflated, and everybody, I mean, you saw on CNBC how everybody owned NVIDIA in their personal accounts. I mean, I saw clips where people were watching CNBC in a bar on the day they reported their earnings, and, you know, it was when it went down, everybody's you know, jeering in the background or whatever. So I think that there was a lot of hype around them in particular, and people are constantly looking for the other plays on top of NVIDIA. They seemingly are the ones that are actually selling stuff right now, right? They're selling those GPUs, and there seems to be endless demand. I think
Yeah,
we're
talking other than NVIDIA. Which is,
Yeah, and
almost its own
like it's
thing.
probably a little too early for some of the software companies to develop, and I think you've seen that, like where expectations ran up for some of these consumption-based companies. They had a good quarter after they maybe, not having a lot of good things going on there for a while. They fell out of bed a little bit, but I think that like people are still trying to find the ROI on the applications. Like I think the hype, like Microsoft and Google and those guys are buying tons and tons of GPUs and developing the large language models, which are eventually going to drive a lot of automation, a lot of change within a lot of industries. But I think it's still a little bit early days there. It's probably becoming more real. You hear more examples.
Yeah, I mean, I'd say, I mean, this probably is consensus, but we're probably early. And, you know, you look at some of the survey work done by, you know, large, you know, Fortune 500 companies, where they are in terms of the adoption cycle of this. And, you know, some, obviously, you know, some of the largest companies like the JP Morgans and the Walmarts of the world are definitely implementing it and are seeing tangible results from both, I think from a revenue perspective, but more so from a cost perspective. So I think we're still, obviously, consensus is that we're early, and I would agree with that. I think that everyone's focused on like the data center aspect of it, but I think you're going to start to see things move more to the edge. So like from like the robotic side of things, was it Tesla tomorrow has their big kind of robo taxi
AI day.
And I think that's going to be, I think that might be what surprises people, not necessarily the Tesla day tomorrow, but like what surprises people is the applications on the edge that I think people are not fully aware of. I mean, you're starting to, it's not this cycle with the iPhone, but you know, it's gonna move probably to the next iPhone cycle. I forget what number we're on now, but you know, 16. Yeah, I think the edge is gonna be the next kind of positive surprise element. Of the AI story. And it's also going to force the hand if the large Fortune 500 companies are seeing tangible results. Obviously, by definition, everyone else is going to have to go invest, right? And it's going to cause obviously some disruption or market share, probably shifting, just continue to shift to the larger companies.
For the Fortune 500 though, a couple of years out before they will start bringing the cash ready for.
Yeah, in terms of tangible results. I think, I mean,
There's probably tangible results today, but I think before you see it move the needle, like where somebody, you know, some company comes on and on their earnings call and says, we're gonna, you know, improve our margins by, something like that. You're probably a couple of years from that, where it builds up to 5 or 6 projects or 7 or 8 projects within the company or something like that. That would be my.
I mean, another way, we own, not in the SPID portfolio, but we own it in mid-cap is Palantir. And, you know, they run these AI boot camps. Basically, it's like a lead gen might not be the right term, but, and I mean, the number of boot camps and commercial signings that they're witnessing are, I mean, it's off the charts, right? So, I mean, it feels still early.
What about alternative energy? Isn't there like a big push for oil-based energy development has been being driven by AI and driven by, you know, other things like that?
Yeah, and it's really gotten a big push from the data centers right now, right? Because the data centers have such a demand, with these GPUs have such a demand for energy and power. And I mean, so now you're hearing people talk about nuclear power again. You're hearing solar, I think, is going to play a big role in it with some of these battery-driven companies.
Companies in this space here, those are all larger companies.
No, we own a couple, Mark. You know, like the Fluence and the.
Yeah, Fluence is probably the best play on that. That's an energy storage company. So it's, you know, it's a play on just the electrification of all industries, but specifically kind of hardening the grid. And it's, you need store, obviously, because of the nature of primarily solar, not, I mean, less so wind. You need a storage aspect to make it work. I think everyone's focused on the alternative energy, or what's in the last week or two is the nuclear, the 3 Mile Island, CEG, and natural gas is, I mean, you're seeing it, like the number of like new natural gas plants that are being stood up. It's definitely like at least a source that's going to be used as, you know, as a bridge to, you know, 2030 or beyond, in terms of when you can actually start to, I mean, because nuclear obviously takes a number of years. I mean, they're basically just taking kind of mothballing, ones that were mothballed, and that's still taking, like, I think the 3 Mile Island is 2028, I think, or something in that ballpark is when they're going to restart it, or plan to restart it. So I think gas is actually is also another way to play it. So
Yeah, I mean, another one in that space, First Solar is one that we had owned. It was actually a pretty nice winner for us earlier this year. We've become a little bit more concerned recently with some chatter we've picked up about the bookings being weak, right? And in India, right?
And they have
Mark?
India
Yeah.
business, which they're changing the regulations or the incentives in India, so it's gonna pressure the business near term. But the First Solar story, yeah, is a great one. I mean, yeah, it's large. Think about like the large solar farms that you see like in the desert. Their panels go into those farms, and the nice aspect of it was, tying it back to like the essential story elements that I talked about earlier. You have like the secular was the adoption of AI and the electrification needing more energy. And then also they have, we don't manage the ESG or sustainability metrics, but we do look for elements that could drive positive moments and positive surprise in a story. And one of which, from the social aspect of it, First Solar's panels are made in the US. And a lot of the competing panels came from China, and some of the labor aspects, if it's the polysilicon that goes into the panels or the construction of the panels, you could argue that it was slave labor. And if you're Google or Amazon standing up a new data center and you want to power it with solar energy, they don't want to go with that, right? They're going with a, most likely made in the USA type of panel, and since that's where the First Solar story kind of fit in.
Quick question, put on that's page 22 on your economic monitor. So it's kind of 2024 there up on the right. Headed for a correction. What do you think?
Yeah, I mean, well, we rank these 22 items every as they come out every month, and we either we force rank them +2, +1, -2, -1. So you've definitely seen a moderation from the significant expansion to maybe more of a modest growth type of environment. If you asked me before the last employment report came out and the Chinese stimulus, I would have said, yeah, you are headed for one. Now, the labor market seems pretty resilient. The China stimulus probably will have some sort of knock-on effect here to US industrial companies, and you have the Fed lowering rates. So it may just sort of stall out here in the modest growth area before it starts reaccelerating next year. Generally speaking, with our philosophy, when you do see growth contract overall for the economy or moderate from really robust growth, the market will pay up for the scarcity of the strong fundamentals and the strong growth inherent within our holdings. So it's not a bad environment from our perspective. I guess I'd prefer not to see a recession in that regard, but
There's still a lot of unused fiscal stimulus, I think, that could be, and we talked about China obviously announcing that large, package last week or the week before, but even in the US, there's still a lot of kind of money on the sidelines that could be used. And we were talking about this a couple of days ago. I don't think it's a result of obviously the China announcement, but the real-time inflation data is actually starting to tick higher again on a year-over-year basis, where the data that we look at, I think it was today or yesterday, broke back above 2% on an annual basis. It had fallen actually all the way down to like 1.2, 1.3%, and still obviously below what's the reported numbers.
Year-over-year.
That's year-over-year, but it tries to track like, I think it's like 80 or 100 different items, and weight them accordingly to consumption. So that's something we're keeping a close eye on, because obviously that could have ramifications for a lot of the names that we own.
jump into performance a little bit here, so, okay. Back here to where this on page 5, you can kind of see the recent performance and our longer term track record. I guess I'd say overall, we're happy so far this year to bounce back after what was really a dreadful fourth quarter overall. It was really disappointing to us. So, it's just, I wouldn't say it was all that dissimilar from, other periods that we've witnessed, whether it was in 2016 for the, when Trump was elected, or I guess there's a period in 2018, like third quarter and the fourth quarter of 2018, I think, when China, we were debating the China tariffs back and forth, where you got some big macro related moves. And really what happened to us in the fourth quarter was largely a result of Powell doing an about face sort of at the last minute at the Fed meeting there, from talking, higher for longer on rates to there was a risk of over tightening, and I guess it was like the end of November, beginning of December, and it just ignited a short covering rally, and when that happens, people generally, sell the long, high quality secular growth names that we own that have been winners and cover their shorts, which are, these usually the secular losers. And that's exactly what happened. And the shorts, skyrocket. Because we hold so much growth and high quality names in our portfolio, you don't tend to, those don't tend to go up as much as what we call the junk, I guess, on the bottom. So you see companies with low sales growth outperform companies with high sales growth, which was more flat, I'd say. Low PE companies and non-earners took off. Our companies typically have, higher PEs, higher valuations overall, and, low return on equity was hit. So, and it was really the whole, I was looking at the attribution today before I came in here, because I'm trying to refresh my memory on it a little bit. And I think consumer staples and utilities were the only sectors where we had relative outperformance. I think staples was driven by like a growth company called Celsius, and maybe Bellring. Utilities, we have no holdings, so it's just an absence of holdings. But like healthcare hit us, financials hit us, industrials hit us, tech hit us, and it was on the healthcare side, it was biotech, because the market priced in lower interest rates, started to price in all those rate cuts. I think six rate cuts at the beginning or at the end of December. And, that ignited all those stocks that have been left for dead. But on top of that, you got a couple takeouts in the biotech space. We don't really invest in biotechs for takeouts at all and speculate. But Cytokinetics and Karuna Therapeutics, they both got, I guess Cytokinetics had really good data, then became the subject of takeout rumors. Karuna actually got taken out. They were like 50 basis points of underperformance. But I remember waking up and looking at the news almost every day in the fourth quarter when some of these takeouts occurred, and they would ignite the biotech index like, 10%, 10%. And, so I'd say that sector alone cost us probably 100 and some basis points, or that industry alone, that sector. And then you had, a number of, I guess what I'll say winners that just sort of reverted. There's a lot of profit taken in winners because of what happened under the surface. We had names like Glaukos in healthcare. That's a med tech company on glaucoma, med tech for device for glaucoma, where they're seeing rapid adoption. There's a lot of catalysts that happened this year, and it's actually been a really good stock this year. But I think it gave up like 50 or 60 basis points on a relative basis in the fourth quarter overall. In financials, prior winners, we had like Kinsale, which is a E&S insurance company that's been gaining share and growing rapidly, that people just became uninterested in, and it drifted lower like 10%, while the rest of the market rallied 20. So that's kind of the nature of what happened. We had a couple mistakes, but I wouldn't say the mistakes were necessarily outsized relative to what we had in any other year. There was a company called Vicor that makes a companion power chip to the NVIDIA GPU processor. So they sit alongside them. They actually missed the products. There had been signs that they were talking up their backlog, and we had seen signs that they had their market share reaccelerated, and they led people to believe that it was on the new generation of chips, but they saw like a bounce in the old generation of chips. The stock went up, we owned it, and then the next quarter they reported it, and it got hit. So that cost us, I think, like 40 basis points or something like that. So that was a mistake. And then Flywire in the the fintech payment space was a loser. I don't remember what happened there, Mark. Do you remember?
They're kind of, they service kind of healthcare and kind of college payments as two of their main verticals, and they do it across a variety of countries. And they had strong bookings, but the implementations kind of, they had a couple of missteps in terms of implementations, which they missed a quarter on, and it wasn't clear kind of why, and, hindsight's 2020, but the idea that, it's a small company that was spread probably too thin in terms of the number of geographies and verticals that they serve, that, eventually that caught up to them. And that was the mistake there.
So,
You look at our reports, like our report that, because the accountants produced.
Yeah.
Here. The numbers don't quite tick and tie a little bit. I'm not sure if you look at it, very carefully, but look at, page 2.
Yeah, our performance isn't as of September 30th.
No, it's August 31st.
And
It's always the first,
Right.
and this is 1 month difference, right? But it's just that, when I look at like the last 12 months and also fiscal year to date, in our case,
fiscal year's only the last 2 months, so it's gonna be difficult to compare.
Yeah, they're probably.
In our
not
full,
using-
Right,
not-
in our
not
full
using-
quarterly report,
Yeah.
not the monthly report, in our full quarterly report, they'll tie out.
okay, all right.
You were mentioned earlier about interest rates and, the minutes came from, the Fed minutes came out and it seemed like there were more people maybe thinking 25 would have been fine.
mhm.
And, small caps, it's considered by the street that cutting interest rates is very bullish for small caps.
Yeah.
So now that maybe they're not gonna, with the jobs number last week, with the minutes coming out, people are saying, well, maybe we're not gonna see 50, maybe we're gonna see 29s or skips.
Mhm.
Do you adjust your portfolio because of that?
Well, I mean, we're always monitoring like the interest rates. I'd say on the margin, we have not like a wholesale changes, like Pinnacle Financial, we sold that, but that was, that's a bank that we had owned that we thought would be a beneficiary of rate cuts and a steeper yield curve. But we had picked up some checks that said that they had a credit issue, right? In one of their businesses. So we actually said, well, we'll take that opportunity that since that's going on to take some chips off the table there. Overall with, I guess a combination of that yesterday, but also the jobs report being stronger, the Chinese stimulus that's out there. I think that we're going to definitely see a little bit moderated interest rate cuts going forward. We're still in a cutting cycle, but with inflation maybe ticking up, maybe not. That's a hard thing to monitor as well. We definitely have our eyes on what's going on, and would probably, to the extent we have any pure play interest rate plays in the portfolio, we probably would err on caution, especially if it had a big run and looks threatening to give back a lot of performance. I don't think there's any of those that are obvious to me, but we've cut back a little bit on Pinnacle. We own TransUnion, that's got a little bit of a mortgage bent to it. They're, secular growth story and some of their software businesses, and but we'll benefit from a pickup in mortgage activity as rates come down. I mean, you saw the mortgage rates go up 30 basis points probably from Friday to Monday, right? So that had been extended stock, kind of probably 20% above the moving averages. We took a little bit off of that, just, to thinking it could come in, given, as we monitor what the next data points are. I think, we really don't love these periods in the market where, I'll say at the very beginning of a quarter, where everybody's trading on such macro information. We're not really going to know how well positioned or not well positioned we are until we get to earnings, but we hold quality companies. So if you look at on page, this Red Ants thing that we put in here on page 14, every quarter we plot our companies on how they report EPS. On the y-axis momentum, it's the year-over-year change in EPS. On the x-axis is positive surprise on a quarterly basis. So that you see that blue dot is 4% average positive surprise for all the companies on this page combined. And that means, you know, they exceed expectations by 4%, but on an annual basis, that's more like 16%. So you'd have 16% more earnings to value, assuming it would flow through. So it's a quarterly surprise, and the change in earnings is like, what, 35-40% there. So we, you know, we monitor this, like this is, and then on the next page, you can kind of see where this is, where it looks relative to history. So that blue dot is, I guess, actually the yellow dot on page 15. That's the most recent quarter. So the positive surprise in our holdings was above,
Increased.
yeah, increased on a year-over-year basis, and it's, you know, it's maybe 1% or 2% better than the average. So we track this overall, and you know, it's just we do what we say we do. Usually when we underperform, it's because the market, for whatever reason, usually a macro reason, isn't willing to pay for the earnings during that period in time. But because we like to say, because of the high quality of our companies, you know, very company specific stories, very secular growth, they're more like tennis balls. So like when they drop, they often come back quick. And that's what you've seen this year with, you know, we had an awful fourth quarter where we gave 700 basis points or so of relative performance back. I think we've gotten all that back this year so far. I think we're up, as of yesterday, we're up like 750 on a relative basis, 18%, around 18% on an absolute basis. So, you know, that's one of the things that we think we feel confident of. I mean, if this dot went down here into this, that would tell me like we really have a problem. So
It's kind of old news, but on page 16 it was the high quality nature of your holdings, why you got hit harder with COVID.
Well, so this page 16, this line, I guess, as importantly as the other one, is the follow through to estimates on the sell side. So the light blue line at the top is our portfolio. The dark blue line is the universe of all stocks we can invest in. You know, I think of it as like the Russell 2500. So our revisions after, you know, like, so they report positive surprise, earnings are revised up. The gap between what our companies do and what the average stock does is about 10% higher. What happens though is during periods like COVID where the lines converge more, it's just that analysts are taking down their estimates on every company at that point in time. So they converge for a period of time, but then you can see how relatively.
So the black and the blue here, dark and they're lined up in that period. Okay. Hard to see that. Okay.
So,
You listen to the conference calls for guidance.
yeah, we do. Our analysts listen to the calls of every company we own and most of the companies we're looking at any given time. And, you know, we use that to gauge what's new. I mean, you know, it's easy to look at the numbers and the guidance, you know, there's summary services where you can get those and see exactly what they are and how they compare to expectations. But we like the analysts to listen to the calls to gauge what's new information that's kind of coming out. Maybe they're talking about a new product in their prepared remarks, some other reason that for the robustness of the quarter, you know, that you might not be obvious from what they wrote in the press release. So, you know, we like to say, you know, when they take all this information, we like to say we're, you know, we put all the information to a mosaic. And, you know, when I talk about like we try to buy something where there's early change, a lot of times it's, you know, if you think of us, if you have 100-piece jigsaw puzzle and maybe you have 15, 20 of the pieces on the table, but you can see an eyeball and a snout and a couple of floppy ears, you say, yeah, maybe that's a dog. It kind of looks like a dog. And then as, you know, so we're willing to make an investment based on limited information and the validation we have. As you get more pieces, it looks more like a dog. That may be more validation where you're raising your position. Some people can't buy it until you see, you know, the tail and the ears and the snout and the nose, right? So that's, you know, that's
I'm
how.
just thinking that using the example of a dog, because sometimes people use that as a phrase for a bad stock.
Yeah, maybe that's not a good one. It's a bull. How about a bull? So, yeah, so, let's see, what else would I say? I guess, you know, on performance, like I said, we've bounced back the market, especially in the first half of this year when the interest rates, all the interest rate cuts that were priced in December last year, kind of found their way out. You know, people kind of exited some of those lower quality names and gravitated towards the higher quality names that we own. And we saw some pretty significant outperformance in the first half of this year. Within tech, we had some AI holdings that did really well. Industrials, the commercial aerospace aftermarket did well for us. We have a stock FTAI aviation, and that's where they're providing, since Boeing and Airbus, the OE parts aren't readily available, they're filling the void there at a lower cost, and all the airlines like that. So that's been a big winner. And then within consumer discretionary, we've done pretty well. We've benefited from some of these, I guess, what are they called? The quick casual restaurant chains like Cava, Sweetgreen. Some of those Sweetgreen's actually an interesting story. That's one that makes, I don't know how familiar everybody is. Yeah, salads. So they've started to, introduce more protein concepts to their menu. Recently, steak, but they also have a very robust unit rollout unit growth rollout over the country. I think it's 10% plus. They're kind of following like the Chipotle model. But the real interesting aspect of that story is all new units are being including this thing that they're calling Infinite Kitchen. And it's basically automation of a lot of the tasks within the restaurant, certainly the serving line. And it's generating, I think, between 700 and 1,100 basis points higher margins for those the new restaurants. And there's plans to retrofit it into all the old ones. So there's a big margin opportunity on top of the strong growth story overall. So we've seen success in those type of companies. The third quarter was a little bit choppy. There was definitely a value bent to the market as the CPI came down and people looked for interest rate cuts. We finished, I think, what is it here? 6.74 versus a 7% benchmark. So we're 25% or 25 basis points underperformed. That number was about as volatile as I've seen it in the course of a quarter. I mean, we're down 300, we're up, we got back to up 100 or 200, and it just kind of bounced around. And I'd say it's still bouncing around a little bit, where we're up like 50 basis points in the first week and a half, which really is somewhat meaningless because we haven't had any earnings, yet. I think over the next 2 or 3, well, probably not next week, but as you get towards the end of this month and the first week of November, we'll start really seeing our companies report. And I'm optimistic that with maybe the Fed with their foot a little less on the gas than it might have been a month ago, and people gravitating towards what should be our higher quality holdings that we can do well. So we'll know more in a couple of weeks, but we'll adjust accordingly if anything comes out from the Fed that would change how we think about the macro. And we're going to find a lot of new ideas over the next month too, because that's usually when you get new information coming out on these.
Okay, good.
Anybody have any questions, or is there anything else you'd like to discuss? You've done an excellent job.
No, I appreciate that. No, I mean, I'd just like to reiterate, we were certainly just as disappointed with the fourth quarter last year as you, and what it did to the more near-term numbers. And, we're working hard to get it back on track, and, we're optimistic, and, we really appreciate you guys and your business and sticking with us when there's such a long-term relationship. We really value it. So if there's anything we can ever do for you guys to get you up to speed more, or, Brett, Kevin, if you ever need us to chat, happy to do a call anytime you want. So
You took the words right out of my mouth. I couldn't have said it better. So that was great. I was going to say thank you and appreciate the long-term relationship. I was also going to say I'm very happy to have supported the portfolio, because I actually have my sweet green salad right here that I didn't eat really, because I picked it up shortly before the meeting because I'm on the West Coast, and didn't eat it, but it is a sweet greens and I'm a big fan. So there you go. But yeah, thank you, everybody. We very, as you can see, and as it was evident today, Chris and Mark absolutely remain extremely passionate about this asset class, and as a result of their commitment and implementation of the process and focus on high growth, high quality companies and growth companies in the mid cap space, they've generated and continue to generate outperformance over the short term and over the longer term periods, right? So So there's some volatility in there, but I think the long-term results are still quite attractive. And we appreciate the long-term relationship here, 10-year relationship. So are very much your partners and would love to add value in any way we can. So reach out to us if we can help. And I'm happy to provide any information that's value add for you.
Thank you.
Thank you.
Yeah,
Thank you, guys.
Thanks.
Thank you.
Dave, to your point on performance, it does look a bit more different than I expect, so we'll go back to our reporting analyst and crunch the data and make sure that what we're reporting is.
So in some ways, didn't make sense, that we look at their numbers and our numbers, it's like there's a 2 or 3 months there that doesn't quite.
No,
tie.
it's more off than I would expect. So we'll take that back to our reporting team and get back in touch with them.
It's a tough business, where they're really trying to stay on top of things, but also buying and selling at that rate.
200%, that's the highest I've heard from any manager. I wonder how much it deteriorates it in terms of how much alpha you have to make extra to cover those transactional costs.
Yeah.
It's a high number.
How do they compare to other managers in that sector? The chart we have for the DC vendors today, do you have that chart for this sector, and how many managers are you looking at in this sector?
So I would say more near and intermediate term, their performance relative to peers has been not great, but longer term.
Longer term is outstanding.
it's
That was
exceptional.
5 years and 8 years, 6
Say
years. how many years ago?
seven,
Some good
10
years, boy.
since inception for Norwalk. My gut is certainly top quartile.
One thing is, when their performance, they've never had a real bad year in the sense that they didn't underperform by 500 or 600 basis points, whereas they did a couple of times outperform.
By that much.
So that's,
Mhm.
you know, I do think that, I mean, small caps have underperformed for what, like the last 9 years?
Yeah.
And it's just a matter of, it's not, it's not the best performing segment of the market.
Mhm.
But within that, you know, we're supposed to be diversified, which we are, you know.
What's their expense structure? Because I mean, to manage this business, it takes an effort, boy.
Well, it used to be called Columbus Circle Investors, and they were Connecticut-based. I think the board hired them in 2013, I believe. And essentially, they used Principal as their back office partner. So Principal was helping them with accounting and, you know, basic support for them to manage the portfolios. And then Cliff Fox, the founder and lead PM, retired about 4 years ago. And essentially Principal purchased the rest of the firm. So Principal as an asset manager is huge.
Mhm.
I mean, hundreds of billions of dollars under management. So the infrastructure supporting them is now significant.
Mhm.
You know, when you mentioned this analyst, there's a pool of hundreds of analysts that they can tap into for research, company specifics. So I think from the standpoint that, you know, they're driving the portfolio construction and where to focus the themes and the names, their support is increasing.
Really good.
When they were Columbus Circle, it seemed like they were more like Cowboys, right? Remember they had like huge swings, outperformed.
They
15.
still do
Yeah, but it seems like they,
a little bit. You know, I mean, he mentioned the fourth quarter, they
They were surprised.
significantly underperformed.
right,
And then, you know, when Cliff retired for 4 straight years, they significantly outperformed. So there is
Yeah.
inherent volatility there. I think over longer time periods, they've proven that they can do it more on the upside than on the downside,
Right.
which has been great.
How do they, look at these thematics that they use? So instead of just looking at the performance of the stock and getting thematics from the marketplace. Do you think that helps them narrow the gap?
Yeah, I think, when they, just listening to them tonight, when they develop a theme or buy a stock with an expectation, they monitor that to see if the theme is playing out. And if it's not, they're gonna cut their losses and move on. And I think understanding what the market is saying, what people on the street are saying, helps them process that. Not sure.
Yeah, so are you saying like, how do they develop the themes that they're, I think there's like the AI is the most obvious theme, right, out there. But maybe it's how to play AI, because the first thought you hear is about the data centers, right? So everybody says, well, great, let's invest in data centers like real estate. But then when you dig into it deeper, you understand, or you learn that data centers are they're constantly evolving, so that in 5 years, the data centers that we have currently are going to be outdated and they're going to need to build new ones. And they can't be repurposed for anything else. So you don't want to really invest in the real estate. You want to invest in the power that's being supplied that it requires, or the little, like the picks and shovels kind of businesses that go into building these structures, and not hold like the physical asset itself. So I think it's kind of understanding those themes and then finding these unique players who have moats around their business, in terms of like the copper company that is being used by NVIDIA with their boards, right? Like something that's so unique like that. I think that's how they kind of try to exploit themes.
Brass fixtures.
Right. So,
Kind of funny.
yeah, and you just, you have to really dig in and do your homework to find those pockets of opportunity, I suppose.
Want to go into performance?
Okay, we'll start with the pension, with the August report. It should be the first, I think it's in this one here, in the green book. Thank you. Yeah, so just real quickly at a high macro level, August was, it was an interesting month. We're going back a little bit here, but it was kind of like a tale of two markets. So the first half of the month was a lot of volatility. There was the whole Japanese carry trade, which if anybody wants to understand it, I can go through it. But there was a big sell-off in global equities, kind of flight to quality, in terms of rates, triggered by some softness on the US economic side of things and some central bank action. And despite all of that volatility, though, at the beginning of the month, the markets did actually end up in the black, as some economic data released later in the month underscored that US economy is still doing really well. And that helped ease a lot of concerns that were growing around potential recession. So again, equities bounced back and amidst some encouraging data. S&P 500 actually posted what was its best week of the year during the month. It ended almost 2.5% higher for the month of August. And in contrast, following what was a pretty exceptionally strong July, US small caps underperformed as markets, and this kind of goes to the conversation we were just having, markets just weighed on the prospect of lower rates relative to slowing economic growth. So the Russell 2000 index fell 1.5% during the month. Outside of the US, markets rallied as weaker US dollar kind of supported returns elsewhere. So the EFI was up 3.3% and MSCI EM was up 1.6%. Rates, they kind of reflected the market's expectation that the Fed was going to start cutting rates pretty aggressively. So in response to that, rates ended lower for the month. 90-day T-bill was down 17 basis points and the 10-year was down 14. That downward pressure fueled pretty positive returns across fixed income assets. So again, just kind of some high level thoughts on the market there. But if we dig into the portfolio, can see that for the month of August, the fund actually outperformed by 60 basis points. Excuse me, the fiscal year to date period, not just for the month, but it was a positive month for the plan itself. And over the 1 year period, it's now off in terms of relative to benchmark by 40 basis points.
Yeah.
A lot of that 1 year number is being weighed down by both domestic and to a slightly lesser extent, the international equity part of the portfolio. And again, a lot of that is coming from some of that concentration in the mega cap on the domestic equity side that markets, everybody's been dealing with if you're an active manager. So I think there's maybe 300 basis points of underperformance for the 12-month period on the domestic equity side.
If I get it back in September.
Yeah, potentially. And, as these 12 months as it goes, that fourth quarter will, and some of those other months this year will start to roll off. So we should hopefully see some of that improved, and things like the fourth quarter for Principal, who was a big underperformer then, will start to roll off as we, go month to month here.
I think as long as the US equity market's being driven by 7 stocks or 3 stocks, any diversification you have is gonna
Brings it down.
create underperformance relative to the S&P 500. It's just every investor that we work with is having the same conversation. And, it's really about diversification for the long term, and how long can 5 to 7 stocks drive a portfolio? We don't know, but when there is reversion, the portfolio is situated to be diversified away from not just stocks. But it's every client of ours is having the same discussion where, we, in the DC plans, one of the managers has an underweight to NVIDIA and an underweight to Apple, and that is all of their performance for the last 18 months. You need to say, because they have underperformed and simply will continue to, as long as those 2 stocks are driving markets.
Do you have a lot of the clients that are like, say, in an S&P index fund?
Mhm.
Because they would just, stick with the market.
Yeah, I think what's interesting is we were having this conversation with a client yesterday. 15, 17 years ago, when you take a look at the total US stock market, large caps, mid caps, probably about 80-85%, small caps, 15%. Today is 6%.
Small caps.
And they continue to underperform.
And it's a much smaller universe of companies. Companies aren't going public. They're being bought. They're going private. I think it's an interesting dynamic in terms of the public companies out there. I think, the Wilshire 5000 at one point had over 8,500 stocks. It has 3,600 now.
The fact that smaller companies are going private now, is that the big driver there, or is it?
Staying private, so they're not
Staying private.
IPO.
They can raise money
Yeah.
elsewhere. It's, they're not using going an IPO as their main avenue to raise money and grow.
But that's the driver, you think?
It's one of them.
Yeah.
I don't know if it's the only one.
Yeah.
But it's just a dynamic that is growing and growing to the point. If you look at the pensions domestic equity portfolio, it has long had an overweight to mid and small cap stocks, because historically there's a premium earned for having a slightly lower market capitalization. And in the last 10 years, it simply hasn't worked.
But now a lot of the smaller companies aren't making money.
That's true too.
Right, the
That's a
non-earners.
big problem.
Yeah, I think we see a lot of people have been passive in core, large cap core for a long time. They called it a day there, and they'll be active on the growth side in large cap and the value side. But to your question, Frank, we'd see more clients asking, should we call it a day on the large cap growth side? Right, if you're benchmarked at the Russell 1000 as well, like, is there still alpha to be had there? And frankly, do we want to get away from discussing the underperformance of our active large cap growth manager every quarter or whatever it is that a good use of our time, or should we just potentially accept beta and move on?
Or do we put money in the S&P 500 index?
Yeah, I mean, you have the Russell 1000 index, which is,
Right, that's what they would do, the Russell one. Yeah,
it's largely the exact same thing.
yeah,
There's
It
not
tracks pretty close, right?
really close.
really, yeah.
Really close.
Just taking a, maybe quick look at a couple of the managers and the pension. LSV, so we'll note that for the fiscal year and really more August, the Russell 1000, the value actually was up 9.5% versus 3.2% for the Russell 1000 growth. Early August, when we had that sell-off, a lot of it was in those large mega cap names. So the value did outperform. However, for LSV, they're very deep value. And so a lot of the pop was the more richly priced stocks in the value index. So they didn't win out, quite frankly, as much as maybe you would have thought or would have liked. Again, small caps, they did outperform large caps during the second quarter, but have trailed, as Frank mentioned, for a much longer time period here. So valuation spreads are really still at pretty historical levels between small cap and large cap. On the fixed income side, TCW, they had a positive month and fiscal year to date, both on an absolute and a relative basis. So the longer duration of their portfolio versus the index really has kind of helped given the lower interest rate environment. And similarly, they have a higher weighting to securitized bonds, which has also aided in the relative performance in the last couple of months. The last one I'll mention is PIMCO All Asset, which has been doing pretty well as of late. They have some positions in the REITs, which have contributed to the upside. They gained 6.3% for the month. That was really in line with the broader equity market. So that was good contribution there. And then allocations to international equity also contributed, as well as exposure to emerging market bonds. That was another big plus for the portfolio. So.
And just so the board's aware, we invited BlackRock Emerging Markets to present in November. Manager that hasn't been in since they were initially hired. They've struggled the first 2 months of the fiscal year. I think longer term performance is okay, but thought it was a good time to have them in.
I'm just curious on the private equity for the Pantheon European net new investment minus 44,000. Is that
The distribution.
distribution? Okay.
Yeah, and we also, I think yesterday, the 2014 fund, they're gonna make a distribution on the 15th of October of 285,000. So slowly but surely. Yeah, the 2014 fund is really the one to keep an eye on. The other ones, we're hoping they,
Oh, it's nice we got the distribution from, every little bit helps.
yeah, agreed.
The only other thing I was going to mention, I can't recall if we shared this with you, but ABS, they have a new strategic partner. Previously, they were owned. Evercore had a minority stake in them. There's a company, a private equity manager called Nile Capital, which is going to be acquiring 23% minority stake, essentially replacing Evercore. So just wanted to make you all aware of that. Strategic investor, we're comfortable with it. Nothing should really change as far as the firm itself, but just something to be aware of. A side note. Maybe if we shift to the DC plan. Oh, sorry, that's right.
It's a separate
Yep,
meeting.
yep. Sorry about that.
No problem at all.
Yeah.
Any other questions on performance?
I always forget that.
Discuss the pension plan fee review. So we're gonna go into executive session. One last piece of business is adjournment. Is there a motion to adjourn? Charlie motions to adjourn.
So I got,
Second, all in favor? Oh, no, no, the second's right here.
Oh, there we
You
go.
put your hand
Second.
up first.
Second.
Come on, we got. You know, he's sitting here politely and, come on. Okay, all in favor?
Aye.
Opposed? No. Excellent. Okay, defined contribution. Let's call the meeting to order for the defined contribution committee for Norwalk and ask for approval of minutes from April 10th, rather, 2024. Did you read the minutes?
Yes, I did.
And you agree with them?
Love them.
All right. So your motion to approve them, and a second, all in favor? Aye. We left you out, I
Yeah,
should.
that's
Performance review.
Okay, let's see, maybe we'll start on page 33. So just one little tidbit that I thought was interesting, and this kind of maybe gets to Frank's question earlier, at least a little bit, but when you look at the asset allocation, there's just two pie charts at the top of page 33. The left is the asset allocation and the right is the contributions.
Yeah.
One thing I thought was interesting is that if you look at the amount of money on the contribution side that has been going into passive funds as of late. So what that kind of tells you is people are sort of riding the wave of the index, the S&P in particular. If you kind of dig in granularly, a lot of people are trying to ride that wave of large caps outperforming as of late, and they've kind of been doing it in lieu of their target date funds. It's worked in their favor. Don't love it from a long-term standpoint. It's tactical, but it is kind of interesting to see how the behavioral side of things is playing out for the participants.
Remember, it was their choice.
That's right. So just one little tidbit there that I kind of found. Taking a look at the page 35, dig into the actual investments themselves. This is the target date funds. So positive absolute returns across all the vintages for the second quarter. The longer dated vintages led the way. They have the higher allocation to growth equities, as you would suspect. Results, you kind of had a range of anywhere from 86 basis points to 185. On a relative basis, all of the vintages did lag their respective indices. And that was, again, this is kind of be a running theme that you've heard a lot, but just driven by the top heavy concentration in the index themselves. It's a few names, frankly, the Apples and NVIDIAs. Really similar story for year to date. All of the series had positive absolute returns across the vintages, but again, lagged their indices, given that narrow breadth of market leadership. And over the trailing 1 year period, positive absolute results for the longer dated vintages, whereas the nearer term lagged a bit in terms of on a relative basis. And this is, more to do with the fact that the longer dated ones have greater exposure to that Russell 1000 pocket of the market, where the near term ones are going to be more conservative. So think dividend oriented stocks.
Remind me what's in your target index, your index?
That's the median target date fund vintage peer. So of all the
Target date
target
funds that you
date
guys see.
funds.
Correct.
So I think the interesting part here is, one, American funds peer performance has been stellar. You can see over the 3 and 5 year periods, the small number to the right of their return is their median ranking.
Yeah.
Or excuse me, their peer ranking. And top quartile virtually across the board, top decile in many vintages. But you'll see that the index, which is the passive implementation of their glide path, ranks better in the top decile across the board, which just shows you how concentrated the US equity market is and what's driving all of that performance, and just being more active in terms of their implementation of the glide path has detracted, but they've still done an extremely good job.
So that, the Callan target, is that is that the full, kind of array of options? Or those are all the options that your clients hold?
So say we take the 2020 calendar target date 2020.
Yeah.
That's all the 2020 vintages from every target date fund provider in the market.
In the market,
Active and passive.
is it, of which you may have, you may have 4 of those across all your clients, but there could be 50 of those in the market.
That's the 50.
That's the
Correct.
50. This is the 50.
Yep.
Correct.
The median of the 50.
Not just the ones that our clients are investing.
Yeah.
So it's trying, of all the investable target date funds out there, what was the median performance
Yeah.
of those peers? That's really what that benchmark is. And, American Funds has outperformed it across every vintage for almost all time periods. Which is great.
Yeah, I went through the numbers a bit. It was like either top 25% or top 10% for every single year. If you look at the last 3 years.
Yeah, no, they've done very well.
And that index is, you said active and passive, right?
Mhm.
So how are they beating, since the passive is gonna be overweighted by the top, whatever we are now, 7 or the big 7 or something, right?
Well,
They're-
you're probably gonna
they're
see the
outperforming
passive
that.
providers outperforming right now because in US equity, they are just buying the index. And so they have a huge weight to big tech names driving the market versus American funds, which is more of a blend approach, but does predominantly use active strategies to do that. And if they're underweight those 7 names in some parts of the equity market, that's inherently going to drive underperformance relative to the passive.
But on a 1-year base, last year, they generally outperformed, right?
It also is a factor of the asset allocation itself, though. So if they choose to hold more equity, which they have, American funds, so versus
They're offsetting
the others,
some of that, yeah.
correct,
Yep.
correct. Some of that,
Okay.
We'll see that on the glide path pages.
you'll see it on the glide path. That's exactly right.
Yeah, so that top chart on that page, you can see it.
Yeah.
It's a good question. Turning the page, just calling out maybe a couple of the funds. JP Morgan Equity Income, they outperformed the benchmark, the Russell 1000 value during the second quarter. That was good. It's been a challenging few years, as I mentioned earlier, in terms of like those kind of higher quality dividend paying names, which have been laggards as of late. So it was nice to see them get a little pop. Again, they're really focused in on those more attractively valued US stocks that pay dividends, durable franchises, consistent earnings, things of that nature. On the flip side, MFS, large cap growth, they struggled. Stock selection was really weak, particularly with information technology. So they're what's called a GARP manager, growth at a reasonable price. So that's going to give them a more conservative growth style that flies in the face of what we've seen in terms of what's been doing well, these kind of momentum names as of the last few years. So that's been really weighing on them. Couple of names, I think Britt talked about them specifically earlier when he mentioned the fact that they hold roughly half of the index weight in NVIDIA and Apple. And those 2 names were 2/3 of the index total return in the second quarter. So you can just imagine how much that weighed on their portfolio. So this is just not an environment where we would expect them to perform well, frankly, and they haven't. But they're not changing. They're not swaying from their investment philosophy and process, which is important for us. We don't want them just to kind of react all of a sudden.
Say it's more of a manager that will outperform in down markets because of the quality and the valuation bias of their portfolio. So as Kevin was, these super high momentum, high growth names driving markets, they're not going to keep up.
Yeah. So more of a ballast, hopefully. On the mid-cap side of things, GW and K, they underperformed the index during the quarter. A lot of it came from stock selection, primarily in industrials. They actually had 10 holdings that were down by double-digit percentage during the quarter. A lot of that was due to earnings misses, but as well as some weakened sentiment for the industry. So a bit of an outlier quarter for them. But over the longer term, the portfolio is still held up well. So again, we're not overly concerned with one bad quarter, but it seems like it was a little bit more of a fluke to have so many names miss on the earnings beat. But just something, we'll keep an eye on internally. And then, I mentioned this earlier, but TCW MetWest, again, that was a portfolio that did better, over recent time periods. So we're happy to see them come back a little bit with their longer duration than the index, serving them well as some of the securitized positions that they hold. Questions on anything there?
I did agree with you, and I found it interesting how many people, because there was a time when the city employees were like 90%, right, in the glide path. Right,
Yeah, I think you'll see it more in the 401A.
yeah, I noticed that too, the 401A is different, but the other thing is, would it be, like, say that there's a fund here and it's doing really poorly, and could we decide we'd force the people to liquidate that holding?
No,
That's what.
essentially, we'd go through a search process like we would for the
Right.
pension. If the board decided, okay, we think there's a better option out there, you elected to replace it, work with Empower. And assuming it's a similar fund, so you're replacing a large cap growth fund with another large cap growth fund, you can actually basically notices go to participants. They say, this fund's being replaced with this fund. If you want to take action, you have to do so by XYZ date. If you don't take any action, your assets will be mapped to the new strategy.
So we probably end up with two.
No, you would replace.
You'd replace it and if
So
participants
when we
didn't
say
make,
they don't take, so if they don't take action, they're automatic converts.
Right.
Can they say, no, I want to keep what I've got?
yes.
So you can.
Go,
end up
like, they
with
can't
it.
say that?
No, they can't stay in that.
say keep what I got. They can go to a different.
Go to target date fund, go to a
Okay.
different fund.
That's, yeah, I just
Okay.
want to confirm that, that's all.
Yeah.
And the other option is, instead of doing that, you could map all of the assets to the target date funds. That's another option.
As a default.
And do we know, because there's not only a measurement of performance, but there's withdrawals from this fund? I mean, basically, like, somebody could cash in their fund, or they could,
Yeah.
leave the program.
It's still growing though. I mean, I think, so the 457 is the more mature,
Right,
older plan. Saw 350,000 in assets leaving the plan, whether that's employees taking their money and
right. I'm just
rolling it
wondering.
into an IRA or.
Right, so I guess, so as a result of that, when you look at like the change in the size of the, like,
It's still growing, believe it or not. I mean, I think when we did the transition to Empower, it was closer to 40 million.
yeah,
I mean, it's been a good equity market, which has helped. But it's, it's over 50 million, which is,
Just over.
I remember when we first started
well, before we
Doing
combined them,
transition.
right, there was only 5 million, I think, in the city's plan, or 8 million,
Yeah, the 401A is almost 20 million.
yeah,
I think it was $1 million when we
yeah,
started
it was really small.
working with you on that.
6 years in, 7?
No,
At least.
with, it started in 2012.
Oh, okay, wow.
They're both, I mean, the 401A is growing faster because it's
Yeah.
not a voluntary plan like the 457, but both are much bigger than they were.
We're fine with everything that we have there now, right? We're not,
Yeah, I think, you know, MFS, large cap growth, if we see a downturn in the market and they don't outperform, I think we have some questions and, but largely, you know, the funds are doing well and I don't think we have any overarching concerns. at this point.
That's only $1 million anyway, so you could move that.
Okay.
Yeah. I mean, you can move any of it easily,
Yeah, it doesn't matter.
it doesn't matter the size so much, but you know, Rick will get into in a second in terms of the fees, but that's an important part of all this as well.
Yeah, just think about the number of people impacted. It's probably a small number of people though.
Yeah, again, that shouldn't be the
Mhm.
driver so much, you know, from your perspective, it's the performance and the
Performance and the
fees.
fees.
Yeah. Utilization usually follows those two.
Those two things.
Agreed.
Can they easily move their existing monies in categories? If they decide they want to get out of MFS, they can move their existing funds out of MFS to something else themselves.
Yep.
They could do that.
Should we have Empower in 2025 sometime?
Yeah.
Yeah.
Is that-
Sure. What's going on?
The fee analysis.
Quickly go over the fee analysis for the DC plans.
What's that?
Page 3.
I'll quickly run through the fee analysis for the DC
Yeah.
plans, so that's right. So this fee analysis, similar to the one we did for the pension.
Do you need to go to executive?
Hmm,
No.
no.
Yeah, we discussed that. We didn't feel like it was necessary.
So I think the biggest difference here is, you know, all of these are pooled vehicles, so either mutual funds or commingled investment funds, so. You know, what we do is compare Norwalk's manager fees to the cheapest institutional mutual funds or commingled funds available. And largely the fees are very competitive. You can see on the right two columns, the net expense percentage and then the peer group median fee. Would note the two in blue are slightly above peer group median. One of the reasons for that is when these plans transitioned to Empower and the new lineup was created, there were no assets in any of the individual investment options. So in terms of negotiating with managers, we had nothing to negotiate because we didn't know if any assets were going to go in any of these options. So I think now, you know, for the SMID cap index and the international index, there's over $1 million in both. What we can do is reach out to BlackRock and discuss internally with our team. Most likely there is a cheaper commingled investment vehicle that Norwalk is eligible for. So we would suggest exploring that avenue to try and get fees closer to the median. Now that there are assets in these options, we're happy to do that. But otherwise, I think all the funds look very, very competitive.
Sounds reasonable.
Yeah, do it.
Okay.
Does, yeah. Surprised that the target date funds are so low from a fee point of view. Is it 0.29 or 0.39? You know, what's more the
It
the
depends
average
on which fund you're in. So the
year?
ones closer to retirement and like the 2010 fund are going to be cheaper because
Yeah.
it's more fixed income.
Yeah.
Farther retirement would be more expensive, but Capital Group's a huge organization and their target date fund complex is very large, which is why their fees are competitive.
Target date funds are arguably the most competitive space in all of institutional because it's the fastest growing space.
Yeah.
As
It's
the
also
qualified.
complicated though. It seems like a lot of work to manage those.
Yeah,
It's called computers.
yeah, that's true.
But aren't they just buying like similar to what we have, you know, paying 4 basis points for stocks and paying,
Oh, yeah.
yeah,
It's their existing portfolios that they're just kind of meshing together,
Yeah.
really.
This
You know,
is,
as you get older, the equity
Right.
risk comes down.
Yeah,
But I mean, we have our own custom target date fund. that we use in our firm.
Do you think it could be considered elder abuse that as you get older, you have to own more bonds? I should have asked that question during the executive session.
It's still applies now.
Okay.
Anything else? Is there anything else anybody would like to discuss? If not, if there's a motion for adjournment. Oh, wait, is there a motion for adjournment?
The motion for adjournment.
Second,
Second.
all in favor?
Aye.
Opposed? No, thank you very much.
What time is it?
We're not done yet.
Is that after?
Got OPEB, right?
No OPEB.
Oh, no, OPEB. We had an OPEB fee analysis here.
Yeah, they said something else, but we had open,
Okay.
Yeah, I think maybe we'll wait to the next OPEB meeting.
Yeah, we had OPEB.